Good morning, good afternoon, good evening everyone, and welcome to Unilever at CAGNY. I'm joined today by Graeme Pitkethly, our CFO. It's great to be with you all again today, and we do look forward to answering your questions after the prepared remarks. Graeme's going to open with a quick overview of Unilever, followed by a reminder of our full year results and how we're doing against our multi-year financial framework. Then I'll talk about Unilever's strategic choices and how they are impacting our competitive performance. Graeme, over to you.
Well, thanks, Alan. Before I start, let me draw your attention to the usual disclaimer as to forward-looking statements and non-GAAP measures. Now, Unilever is a 52 billion euro company with nearly 60% of our revenue from the emerging markets. The company has a far-reaching global footprint, and depending on your definition, we may just be the most global company in the world. Why do I say that? Well, 3.4 billion consumers use our brands every single day, and we are actively selling our products in 191 countries around the world. We have a strong presence in the geographies that will be the engines of global growth in the years ahead. And this includes our three priority markets, which are the USA, China, and India. Whilst the emerging markets have been hit hardest during the pandemic, we have the scale, the talent, and the market leadership positioning to capitalize on the recovery in emerging markets. We have 13 mega brands that together deliver almost 27 billion euros in turnover. And for 4 consecutive years, we've been recognized as the world's most effective marketer by the prestigious Effie's Advertising Awards. Our brand power is really strong, with over 80% of our turnover increasing or holding brand power, and we have created a very strong digital data foundation to use in targeted marketing. And we are an acknowledged global leader in sustainable business, having topped the Dow Jones Sustainability Index since 2014 and coming top of the Globestan Sustainability Leaders Survey for over 10 years now. This strategic commitment to building a sustainable business that delivers superior financial returns requires time and effort, but it's worth it because millennial consumers, who represent the largest part of our consumer base now, expect that businesses and the brands that they use will play a positive role in society and for the planet. And this will only increase as Gen Z become a bigger part of our consumer base. That's the industrial logic of our sustainable business strategy. Now, we've delivered 4.5% underlying sales growth in 2021, with 1.6% of that coming from volume growth. Pricing stepped up to its highest level in a decade as we responded to the significant inflation that we're seeing across commodities and other input costs. And by Q4, in fact, we were pricing at the level of 4.9%. We believe that fast action on price is the right thing to do to preserve our ability to invest behind our brands, but at the same time, we have maintained good levels of competitiveness, ending 2021 at 53% business winning value share, and in fact posting a second full year of growth that is competitive. Underlying operating margin for the year was 18.4%, which is down 10 basis points versus last year and in line with our guidance of around flat. Free cash flow was once again strong at 6.4 billion euros, and return on invested capital for the year was 17.2%, in line with our goal of mid to high teens. Underlying earnings per share, or EPS, was up 5.5% in current currency and by 7.8% in constant currency. Leverage remains in line with our target, which is around 2 times EBITDA. For 2021, we also declared a 3% increase to the dividend, taking it to 4.4 billion euros for the year, and announced a further 3 billion euro share buyback over the course of 2022, taking total buybacks since 2017 to 17 billion euros. Before I move off 2021 results, I want to put that performance in the context of recent years, because it really shows how our focus on 5 clear strategic priorities and on improving the operating fundamentals of our business are starting to be reflected in accelerated performance. 2021 underlying sales growth was the highest we have delivered in nearly a decade. This was helped by a relatively low comparator in 2020 as we managed our uniquely global business through a global pandemic. But on a 2-year stack basis, which adjusts for this, our growth is firmly back above 3% and continued to accelerate during the year, crossing the 4% level in Q4. And this was achieved despite parts of our business in out-of-home channels, for example, our food solutions business, still not having recovered to 2019 levels. Restoring Unilever's competitiveness has been a key goal for us over the last 3 years. Our competitiveness had fallen to a level that was frankly unacceptable, and we needed to fix that, plain and simple. We've made good progress, with 53% of our business winning share in both 2021 and 2020 itself. Growth remains our priority, but margin progression is also an important component of our value creation, and the underlying operating margin was flat in 2021, despite the arrival of high inflation from the middle of the year. Looking forward to 2022, we see that input costs will step up even further, and we are guiding 2022 margin to be between 16% and 17%, but restored relatively quickly thereafter, with the bulk of it coming back in 2023. Let me give some more detail on the impact from inflation on margin in 2022. Now, this chart has a lot of detail, but it's very important. It shows some history on the levels of net material inflation in absolute euros that we have seen in the past, how we've priced for that, and how quickly we recover the gross margin impact as a result. Net material inflation, or NMI as we call it, is how much the business will be impacted by market inflation on our 20 billion euro input cost base after the benefit from hedging and global procurement actions such as buying scale and product logic savings. As you can see, NMI has been at quite low levels for the last 10 years, up to 2020. But in 2021, we saw a significant step up to levels last seen over a decade ago. And looking ahead to 2022, our projections indicate that we will experience even higher NMI. We expect market levels of inflation to move from the mid-teens percentages in 2021 to over 20% in 2022, and with fewer hedges in place and a higher cost base, more of this will flow through to NMI. While there are wide ranges and a lot can change, we are currently projecting around 3.6 billion euros of NMI for 2022. Now, to put this into context, the unmitigated impact of that level of NMI, if we were to take no pricing or implement any other savings initiatives, would be around 700 basis points on the gross margin. We see increases in almost all of our input costs across vegetable oils, crude and crude derivatives, packaging, freight and distribution, energy, and labour costs. Looking at the historic data shown here, you can see that we have always stepped up pricing where inflation required us to do so, but usually not to the extent as to fully recover gross margin in a discrete year. Importantly, however, gross margin has then recovered quickly in subsequent years once cost inflation normalizes and the full effect of pricing lands. The high inflation and brief declines in gross margin in 2008 and 2011 best illustrate this. We will continue to take further price increases in order to manage this 3.6 billion euros of cost inflation in 2022, but these need to be phased in and will lag the full effect of NMI. We will continue to step up our savings programs, and our deep knowledge and experience on landing price in our markets gives us confidence we will be able to manage the careful balance between pricing and volumes in a healthy way. The impact of this level of NMI means a short-term hit to profitability as we maintain competitive levels of investment, and we will not compromise on that. It does deliver higher levels of growth in 2022 at between 4.5% and 6.5%. And we are confident, based on the data that I've just shared with you, that margin will be restored quickly after 2022, with the majority coming back in 2023. The building blocks of that margin recovery are threefold. First, input cost deflation. Secondly, a low single-digit pricing carryover as price actions catch up. And thirdly, savings delivery, including from our new organisation model. These are reasonable assumptions, and should allow us space to both recover margin and invest more in the business should it be required. I'll now hand you back to Alan for an update on strategic progress. Alan.
Thanks, Graeme. 2021 does represent a step up in Unilever's operating performance. The momentum in the business is coming from disciplined action on the 5 strategic priorities that we set out a year ago. It's these choices which will continue to sit at the heart of our strategy for value creation. Let's start with winning with our brands. Our 13 €1 billion plus brands grew at an aggregate 6.4% in 2021. Some key performances to call out here are Dove, which grew 8%, and that's the fastest growth in 8 years. Hellmann's, which grew 11%, and our ice cream brands, Magnum and Ben & Jerry's, both growing 9%, and all against strong comparators, so these are not COVID bounce backs. Product superiority and innovation are key to the success of our brands. Superiority in blind testing versus competition is now over 70% of tested turnover, up from less than 50% in 2019. Our focus on driving bigger, better and more impactful innovation delivered over €1 billion of incremental turnover in 2021, and that's double the delivery the year before in 2020. The Allah brand shown here is a fantastic example of our innovation funnel working for us and working for our consumers. This dilute at home laundry detergent is 25% more affordable for consumers, offers superior cleaning performance, uses 70% less plastic, and all at a more attractive margin for Unilever. It's one of the key innovations in Latin America that has allowed us to increase prices in an exceptionally inflationary time and remain competitive. In order to keep winning with our brands, we intend to continue investing competitively, even with unprecedented commodity inflation in 2022. We've chosen to prioritize the key growth markets for the future with an overarching priority on the US, India and China, as Graeme said. First, the US, our biggest market with over €10 billion of turnover. Full year growth was 3.7% and we have a 2-year compound annual growth rate of over 5%. We have really turned a corner on competitiveness in the US with over 65% of the business now winning market share. The health and well-being and prestige beauty businesses are contributing strongly, with the US being the home market for most of the brands in those portfolios. Let's move to India next, our biggest emerging markets business with €5.6 billion of turnover. Hindustan Unilever really is a jewel in Unilever's crown, with strong leadership positions in most of the categories that we operate in. Growth in 2021 was 13.4%, even with some periods of severe COVID-related restrictions in the country. The proportion of our business winning share has been consistently improving and is now at over 75%. You know, as market leaders, we also carry a strong focus on market development, growing penetration, growing per capita consumption, and premiumizing for this critical market for the future of Unilever. Market development is a core Unilever capability that we deploy in many emerging markets around the world. And thirdly, to China, with a turnover of over €3 billion and now Unilever's 3rd largest market. Our growth in 2021 was 14%, again competitive and volume led. As well as continuing to build our core power brands in China, we've begun the rollout of our prestige beauty and health and well-being businesses. Next, leading in channels of the future. E-commerce is our top priority channel for growth and grew 44% on the back of an exceptionally strong year in 2020. This growth came across all of the main sub-channels of e-commerce. In just 5 years, the channel has gone from 2% of Unilever's turnover to 13% in 2021. And this is the result of significant investment in both expertise and tech capabilities. We've built, for example, 47 digital hubs across 40 markets, managing nearly 2 billion digital IDs and nearly 200 million personal contact details for direct targeting. Our 21U studios have won the Global In-House Agency of the Year award again and have delivered over 1.5 million assets across 35,000 projects. And our 37 people data centers are delivering real-time data insights to our sales and marketing teams. We are a future-fit digital business, and we will keep developing and investing in these areas. This will ensure we stay up to date, and it will result in this channel continuing to be a material contributor to Unilever's growth in the coming years. Marketing is changing. Unilever's marketing is changing faster. Our fourth strategic choice is to build a purpose-led, future-fit organization and associated growth culture. And key to that is putting in place the right operating model for the business. Now, we've known for some time that the matrix structure we've operated under, with 3 divisions and 15 regional performance management units, was relatively heavy and not as simple, fast, or clear as it could be. So we started working on the future organization model for Unilever in late 2019, but concluded that making such a significant change in the depths of the COVID crisis would have been the wrong move. We restarted the work again in the second half of last year and announced the conclusions of that work last month. We're making a major change to move from a matrix to a category-focused organization with sharper focus and deeper expertise within each category. We will have simple end-to-end responsibility for the strategy, for the P&L delivery within each business group. The new organization removes the complexity of decision-making that came with a matrix structure and provides crystal clear accountability for performance and delivery. And we will, of course, continue to leverage Unilever's corporate scale in our corporate centre and in a highly tech-enabled business operations layer. The new organization was built primarily with a focus on growth. However, it is a simpler, leaner model, and so will also unlock some 600 million euros of savings. We'll be organized around 5 business groups: beauty and wellbeing, personal care, home care, nutrition, and ice cream. Each business group will be fully responsible for their strategy, their growth, and their profit delivery globally. This category-focused design will enable us to be more responsive to consumer and channel trends with crystal clear accountability for delivery. For example, the Beauty and Wellbeing Business Group will have a very strong focus on growth channels such as beauty stores, drugstores, direct-to-consumer e-commerce. These channels are less relevant to, for example, our nutrition business, where out-of-home, grocery, and omni-channel e-commerce are the key channels to grow the business. This new operating model will give nutrition and ice cream even more power to drive performance by responding to the consumer and channel dynamics that are unique to each business group. And to be clear, we see a bright future ahead for both businesses inside Unilever. We will have a lean corporate centre where our company-wide global strategy and priorities are set and led from, where capital is allocated, and where our top talent is managed. And we will leverage our scale through Unilever Business Operations that will host our transactional backbone, IT infrastructure, and massive data sets in service of the 5 business groups. Each business group will consist of 7 or 8 geographical business units. And these are groups of countries which have similar customers, consumers, and channels, each led by a very empowered general manager. And this slide shows the structure for personal care. The role of each business unit, based, by the way, in local markets, is to deliver the strategic priorities and performance targets set by the business group. But each will have dedicated marketing, sales, R&D, digital, finance, and human resource teams, as well as supply chain resources. This is an exciting change for the company. The new model kicks in on July the 1st. Accountability and our reporting of Unilever's results will remain in the current organization for the first half of the year, and we will move to reporting our results in line with the new structure for the second half with, of course, comparable historical data. And this leads me to our fifth strategic priority, which is to continue the move of our portfolio into higher growth spaces. In parallel with achieving the unification of our legal structure, our board went through an extensive process to review strategic pathways to reposition Unilever's portfolio into higher growth categories for the longer term. This work concluded that expanding our presence in health, beauty and hygiene would expose Unilever to structurally higher growth. Regarding large-scale acquisitions, we have drawn a line under the GSK Consumer Health proposal, and we do not intend to pursue any other major acquisitions for the foreseeable future. We remain resolved in our strategic direction, but we will be measured in how we get there. Over the last 5 years, 93% of all M&A capital deployed since 2017 has been in either prestige beauty, functional nutrition, or beauty and personal care. In contrast, 98% of the disposals during that time have been in slower growing foods and refreshment categories, the big two here being obviously spreads and tea. This has structurally changed the growth profile of our foods and refreshment businesses for the better. Overall, our portfolio rotation as a percent of turnover has been about 17%, and that's ahead of our peer average and in line with the best regarded companies in our sector. I want to stress that throughout this rotation we have been disciplined in our capital allocation, and that's reflected in good return on invested capital, which remains in the mid to high teens at 17.2% in 2021. And we will continue to be disciplined allocators of capital in the future. Portfolio change is making a difference to Unilever's growth. Exiting spreads has improved our growth by an estimated 40 basis points last year, and the acquired businesses contributed 70 basis points to 2021 USG. Looking in more detail at functional nutrition and prestige beauty, together they're now making a meaningful contribution to our group USG. For the full year, these two businesses contributed over 50 basis points, but you can see the trend has been rising, and in Q4 they contributed 70 basis points. And that is with some of the more recent and fastest growing acquisitions like Liquid IV, which came into Unilever with sales of 50 million and delivered well over 300 million of sales last year, still not fully reflected in underlying sales growth. Let me give you a little bit more of an update on prestige beauty and vitamins, minerals and supplements, places where we've focused most of our M&A capital. We began our journey in prestige beauty in 2015. We've acquired 9 businesses, with the most recent being Paula's Choice last year. These brands now make up 1 billion euros of business, present in over 100 markets, though concentrated in the big prestige markets of USA, UK and China. Prestige beauty grew 24% last year, and e-commerce is now nearly 50% of the business. Our strategic move into functional nutrition began with the acquisition of Equilibra in 2018, followed by Ollie, Horlicks, Smarty Pants, Liquid IV, and most recently Onnit. In only 3 years, we've created a 1.5 billion euro business, which grew 22% last year and now has some very strong leadership positions. In the coming years, we intend to build both Unilever Prestige and Functional Nutrition to over 3 billion euros of revenues each through sustained strong organic growth as well as continued bolt-on acquisition. So this wraps up how we're doing against the 5 strategic priorities for our business. Before I close, let me remind you of the performance acceleration that is happening at Unilever. We're stepping up growth, with 2021 representing our highest growth in 9 years. Perhaps best shown on this 2-year CAGR quarter-by-quarter basis, where the acceleration is clear even on a 2-year stack basis. The strength of our brands is allowing us to price boldly to counter unprecedented inflation. And our competitiveness has been at 53% for the past 2 years, and that's a real step up on the previous 4 years. In 2022, we are 100% focused on sustaining this acceleration of our existing portfolio, and we do see continued growth momentum as we start this year. The measures we put in place through our sharpened strategic choices and focus on operational excellence are working. We face the highest levels of inflation for over a decade, and the business is responding by leading on pricing behind our great brands. The full year operating margin is expected to be down between 140 and 240 basis points, and within this, we will not compromise investment, and we plan to maintain competitive levels of spend in BMI, R&D, and CapEx. An organisation change will be a further accelerant of performance, building a simpler, faster, and future-fit Unilever with extreme accountability. Thanks for watching, and we look forward to taking your questions.